Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Let's move over to the electric vehicle space. This week is the big week for the non-Tesla companies. I wanted to touch base on Lucid, which we thought we were going to get to yesterday, but ran out of time. The big number, the challenge with Lucid and a company like Rivian, which we'll talk about in a second, is they're not mature companies. So we're not judging these companies on their net income or their cash flow. Really, the two things I'm looking at are what do reservations look like? So how many people are standing in line, and how long is that line getting, or short is it getting? And what does your production look like? Because you want to have production growing, and you want to have more and more people demanding the vehicle that you're making. So if either of those things break, that's where companies are get into real trouble. We won't get into modeling out when they're going to get to cash flow positive and stuff like that, because I think we're years away from that for both of these companies. Lucid, the challenge, and the stock was down today, is they said their annual production guidance is going to be 67,000. I don't think that was a surprise. What was a surprise was 34,000 reservation holders, which I believe was down from 37,000 a quarter ago.
That number's going the wrong way, right, Travis?
That number's going the wrong way. That's a 10% decline in one quarter. That's a big drop, and we'll see. What
are your thoughts about why that's happening? I know you have some thoughts.
Well, yeah, I have a lot of thoughts. I mean, I am a reservation holder for a Rivian R1S, and my reservation just got pushed out to at least 2024 at the very earliest. And the challenge for me is, we need a vehicle. We're a growing family. We need, the appeal of the R1S was it's a 7-seat electric SUV. There are no other real 7-seat electric SUVs that cost less than like $120,000. I think the Tesla model, is it Y or X is
the Model X, right?
The Model X is like 120 grand at this point, and it's not the same size as a real SUV.
It's more of a crossover. It's not the full SUV with the space that you would get.
So that was the appeal for us. So that's the reason that we were a reservation holder. Well, you push us back, and I was expecting to get a vehicle within the next, let's say, 3 to 6 months. Now we got to make a decision as a family. And there's probably, I assume there's a lot of people in that position. Now, maybe a bunch of the reservation holders for a Lucid can wait and don't really care if they get it this month or next year or the year after. They're just going to sit there and because they want the vehicle. I think that's going to be a strange balance. The other thing to throw into that is, as we go into either maybe we're in a recession or going into a recession, interest rates are rising. The idea of buying a $70,000, $80,000, $120,000 electric vehicle becomes a lot less appealing. So do we see demand for these vehicles fall simply because buyers can't afford or don't want to spend the money on vehicles like this? It's an open-ended question right now. And the fact that their reservation holders, the number of reservations is falling, I think is not a great sign. This is not a stock I've ever owned, so I don't have strong feelings one way or the other. But it's one of these where. What are your strong feelings, Jason?
I do. Before we get to those, I want to point out, talking about recession, inflation, all those things. To get your place in line, that's $1,000, right?
Yep.
And
what the Rivian is,
and it's refundable, which is as it should be, right? I wonder if some of that impact isn't people that are like yourself that are gone from, hey, you're going to get it early next year to you might get it late the year after, and they're like, I could use that $1,000 for other things right now.
Absolutely.
So maybe they still have an intent, but it's gotten to the point, well, that it's like buying the fast pass for Disney, and they tell you, well, you're still going to have to wait an hour and a half, right? It's like, no, I'm not going to spend that money to not really feel like I'm getting an advantage. So maybe
what's the point of standing in line if I'm going to be in line when their production reaches 200,000 units a year?
Right.
There's not going to be a 2-year wait 2 years from now. So what's the point in giving you my money to stand in line?
It's the old commuting analogy. I can leave now and it takes 2 hours.
Yeah.
Or I can leave in an hour and it takes 45 minutes. That math doesn't really work out, but it feels that way is the point.
Yeah.
And I think there's a lot of emotion that's tied to a lot of those $1,000 deposits that people have made. So there's that. Here's my thoughts, Travis. You ready for my thoughts?
I'm ready. Let's go.
I see so many investors out there that are looking at the Rivians and the Lucids and some of these other EV companies, and they see Tesla with this multiple hundreds of millions of dollars of market cap and the massive returns that investors have earned owning Tesla. And there's this idea that you're still going to capture, that you can capture that same sort of thing with Rivian and with Lucid and again some of the others. And I want to caution people because I think it's one of those things. And Travis, we've talked about it on the show with other things like the solar panel industry. There's the trend for the industry where there's obvious growth and it's going to be disruptive and it's going to dominate. And then there's what is the case for shareholder returns, right? And I'm becoming more and more convinced that in as much as these stocks have fallen, they're down sharply, right? They're down sharply from their highs. That these companies aren't necessarily, even at these prices, aren't necessarily going to be market beating investments for people, because General Motors and Ford and Tesla and all of the other global automakers have really only over the past year or so made a concerted effort with billions of dollars into building out capacity for electric vehicles. And that's going to take the game back to the economics that it's always been, right?
And guess what? They know how to scale.
Yeah.
I think that's the piece that is really hard to quantify. If you are interested in a stock like Rivian, they might be the next Tesla, if you will, because they can sort of rethink the business model. They don't have dealers. They can service your vehicle in your driveway. They can do a bunch of things that General Motors can't. But General Motors can say, we're going to make an electric SUV and we're going to make it next year and we're going to make a ton of them and you're going to be done. So that's the balance.
Yeah. I know we're going to get a lot of comments on this video about that, but I just think it's the reality. We've seen the story play out too many times in other industries to think that it's necessarily going to be different. I just want to caution investors. So yeah, we got a call out from somebody yesterday on the YouTube asking for this one, and we missed it. We didn't see your comment until after. So hopefully you're watching today, and we can help you scratch that itch.
I can't get my screen share up, but I'm going to go through the numbers here for Rivian based on the numbers that we talked about. So is the backlog growing? 114,000 R1, so that's R1T, the truck, and R1S, the SUV, reservation holders as of November 7th. That's up from 98,000 on June 30th. So that is a positive sign that the number of reservation holders is increasing even faster than they can make vehicles.
There you go. There's the slide.
There's the numbers right there. 15,000 vehicles produced. And the big number that you still want to keep an eye on is that $14 billion number. $14 billion in cash. That's down from $15 billion a quarter ago. So they're burning cash at a really rapid rate. So the question is, can they get
that's expected, Travis, because that is expected.
That's why we're not valuing this company based on free cash flow, because they're going to be spending a lot of money, both now ramping up production, but then the next step is building out this facility in Georgia, which they said they still expect to be operational in 2026. We'll see if that is the case, but they're running into some roadblocks there with the agreement that they had with the region and basically the subsidies that were involved. So that could be a little bit delayed. But generally, from a production standpoint, they're still shooting for 25,000 vehicles. They made that prediction early this year, and I think it's generally a positive sign that they're still sticking by that they're going to work through any challenges that they had. That would be a run rate of about 10,000 vehicles this quarter. That's a lot of vehicles. So
yeah. That's a step in the right direction, and it's not that long ago that that's all that Tesla was making too. But the hard part is getting from where they are now to getting to that, and then to 100,000, and then to 1 million a year, right?
Right. And they're going to need to expand their capacity, but 25,000 a year. Well, let's take the 10,000 per quarter run rate is about 40,000 units per year on an annualized basis. Their current facility can make about 150,000. I think they said 200,000 with an expansion. So it's conceivable that they could get to that kind of run rate maybe late next year, into sometime into 2024. That would be, I think, pretty impressive. Now you've got to build that Georgia facility and build your whatever the R2 package is. I think that's going to be maybe even more challenging than building the first one. The other thing that they talked a fair amount about was the delivery truck, the EDV that they're delivering. They still have a 100,000 unit order from Amazon, but there has been news that they are now selling those to other third parties. So I think everybody thought that was an exclusive deal for a period of time. Maybe it was, maybe the terms were changed a little bit, but we're starting to see those in the wild. That's one of those things where they can build a platform that I don't know that anybody else can, because they can start from scratch and they can build in all the tools. I mean, when you're a brand new manufacturer and you're working with, is it the biggest retailer in the world now? If it's not, it's close. You can see exactly what does a company that runs at that kind of scale need and build for that, and then start to offer some of those services. And that's what they're doing is they would have software as a service with these electric delivery trucks to smaller delivery companies. So that's potentially a really interesting business for them, and something that they're maybe not going to have a ton of competitors in. I mean, if you've seen UPS trucks around, they're still the same trucks that were made 40 years ago. So there hasn't been a lot of innovation in that space in a long time. This is a company.
You know what the innovation's been in those vehicles? In the fuel sources, going to lower carbon fuels, looking to electric vehicles, that sort of thing. But like the actual operation, you're right. I want to caution people, Travis, again, because you look at the market value for Rivian stock, and it's clear investors are pricing in that as part of its future. It barely exists right now, and it's not anything that's making the company, a material amount of revenue or cash flow. So,
are you talking about the electric delivery vehicles?
Yeah. So, I mean, in terms of you just be careful about valuing those sorts of things too much is the point. Travis, we want to take a look at cash flows, cash burns real quickly.
Let's look at it.
I got it right here. I'll pull it up for us. So operating cash burn was about $1.4 billion. That's double where it was a year ago. Again, not unexpected, because again, using Tesla is kind of the test case. I know I said it's not going to be the next Tesla, and then I'm telling you to use Tesla, but there's an operational cadence that we can use that's helpful. And part of that is it spends the CapEx and expands a facility, and then adds operating expense as it's building inventory and it's bringing it online before it's generating cash flow from selling the vehicles, right? So this is not unexpected that this has happened, right? We're also seeing CapEx actually came down, but again, we're continuing to see CapEx spend. Free cash flow, I want to talk about this just really quickly, was of course negative, about $1.7 billion. That's accelerated largely because of the increase in operating cash burn. All expected. The key is, if you're going to follow this company, if you're going to invest in it, Travis, just like we've talked about, it's going to continue to burn through cash. We know it has, what, $14 billion on its balance sheet?
13.8, yep.
Yeah, 13.8 billion. And it also has a revolving debt instrument that's tied to assets, right? So as it scales up and acquires assets, it'll have access to more and more debt, right? So it has ways to access capital. But the catch right now, Travis, is the balancing act, right?
Yep.
Of careful capital allocation, growing your operations as you're scaling up your ability to make and sell more cars.
So let's go through some of the things that we talked about early on. What are we looking for? The number of reservations is growing, and growing more quickly than they can make vehicles. I think that's a great sign.
Yeah. As opposed to Lucid, where we're seeing deterioration in that metric.
Absolutely. The question is, and we'll see if they talk about it on the conference call, which I don't believe I think it starts in just a little bit. We don't know what production expectations look like next year. We talked about the fourth quarter. They're going to do about 10,000 vehicles this quarter. You would expect that to continue ramping up. But I like to sometimes just kind of do some back of the envelope math and go, okay, if you're making 25,000 vehicles a year and you sell them for $80,000, here's what revenue looks like. Here's what your operating costs look like. What do you have to get to kind of pencil out cash flow break even on an operating basis? And when we get that guidance and sort of figure out what the ramp is going to look like next year, hopefully we'll start to get a better feel for that, because clearly the market is not in the mood to fund companies like this in perpetuity. Yeah. On the, you know, in the reality is they were in that mood when Tesla was in this same phase. You remember Tesla went back to the market over and over and over again, raising capital, and it wasn't a problem. If Rivian comes out today and says, hey, we need to raise $10 billion, it's not going to happen.
No, that's a third of its market cap. It would be a challenge right now at this scale. The market needs to see scale, needs to see scaling up, selling vehicles, continued demand for more plants like the Georgia plant, right? And if the market sees that and sees good economic activity, you know, then getting $10 billion, the conversation changes. But as the business exists today, yeah, it's not going to happen.
All right, my final thoughts on Rivian and Lucid. Lucid, I think that was a pretty bad report, even just on a surface level. You just don't want to see reservations going in the wrong direction. Rivian, I think, seems to be going in the right direction. I'm interested to dig in this a little bit more and see what the challenges are for the company, because, you know, are we clear sailing on them continuing to scale the business in 2023 and into 2024? I'll put my emotions aside as a reservation holder and getting pushed back there. And just, I'm not a shareholder at this point, but I am intrigued by Rivian because I do think the disruption in the auto space is these business model disruptions. It's not that they're making an electric vehicle that General Motors can't make.
Right.
They can make the same vehicle, but they don't have dealers. They don't have that segment of the market, of the business to deal with. They can rethink servicing vehicles. They can rethink what our software looks like. They can rethink all kinds of things that General Motors just structurally as a business can't redefine. And that could lead to fundamentally higher margins long term. That's why Tesla has better margins than traditional automakers today. We'll see if that continues, but that's why I think this is an intriguing company. If I think that the risk reward is there and we get past this kind of can they survive point, then it's much more intriguing to me.
And we're getting closer. My final thought is just agreeing with everything you said, plus one addendum. We've seen Tesla also be able to hold those margins, not just because of the difference in its business model, which is meaningful, but also because it really hasn't dealt with any competition. Mm-hmm. That aspect is going to change. Now, at the same time, costs are coming down for like things like batteries. It's going to help absorb some of that competition too. But 3 or 4 years from now, when you're seeing the largest automakers have meaningful, real high volume EV products and they're competing more on price, that's when we're really going to find out the kind of margins that these pure EV startups today that are just pure EV companies with a differentiated business model, then we're going to find out what's the difference in the margins they can get and the difference in their operating leverage versus the traditional Fords, GMs, and Hondas. So for now, I'm a really interested observer. But I think you're right. They could be compelling, but we need to learn a little bit more.
Yeah, absolutely. Love to hear your thoughts though. Leave those in the comments section below. And, you know, Jason and I will try to get to those and, you know, answer as much as we can, but there's a lot of unknowns for both of these companies, both Lucid and Rivian.